you very much, Dan, and good evening, everyone. I'm going to really focus on the sort of structural advantages of City of London, but I'll also talk a bit about how the portfolio is positioned and how I'm seeing the markets today. So if we move on to the first slide. So City of London was actually originally a brewery company, and that picture you can see was the brewery of the City of London, which sat on the banks of the River Thames. It was loss-making, and in the 1930s, the board decided to sell the brewery, which was valuable, and is now an office block, as you can imagine, and invest in shares, become an investment trust. But they still owned pubs until the 1960s. And in fact, when I first became portfolio manager in 1991, there were still a few pensioners who'd worked in the pubs who we paid pensions to, that unfortunately, obviously, they've all passed away now. And so for many years, since the early 60s, we've been wholly invested in shares. Obviously, one of the features I always emphasize, and probably coming a bit from our long history, is having an independent board of directors. That's a key component of investment trust. I have 7 board meetings a year with the board, and they act as a critical friend, and I kind of present my investment strategy to them, and they ask very good questions. Our chairman is Sir Laurie Magnus, who has a long career as an investment banker, corporate financier, advising companies, and he's still an associate with Evercore, but he's also 2.5 years ago he was appointed ethics advisor to the Prime Minister, who was Rishi Sunak at the time, and he's kept that post under Sir Keir Starmer. It's a 5-year term, and he deals with sort of controversies involving ministers from time to time. The fund is managed by Janus Henderson, who I work for. Janus Henderson was a merger. Henderson's was I worked for originally, which is a company going back to the 1930s itself, and it merged with Janus, an American fund management company, back in 2017. That's been a very good merger. Janus, obviously having that extra insight into the US markets is very helpful, and Janus is particularly well known for the strength of its analysts, and I'll give a good example of that later. I've been fund manager since 1991. Which is a very long time, and I'm immensely proud to have worked for this trust for such a long period. My deputy is David Smith, who I've worked with David for over 10 years, and he was appointed deputy in 2021. And we both work in the global equity income team at Janus Henderson. And the trust has assets of slightly over 2 billion. So in our sector, which is UK equity income, we are the largest trust in that sector within the investment trusts. There are other big investment trusts in different sectors, but we're the biggest in our UK equity income sector. Next slide, please. So just talk about some of the aims. Is we're predominantly invested in UK listed businesses, but actually, as I'll show, pretty global. Our goal is a mixture, is to both grow income, a growing annual dividend, and we've done that for 58 years, which is the longest of any investment trust. I'll talk a bit more how we achieved that, but also capital growth, so provide an overall total return. And we invest in leading UK companies. They're often very global. We'll show you a bit more about that in a moment. We have, courtesy of that independent board, a very low fee. It's only 0.3%, which is the lowest in our sector. And we also have a very conservative approach. We're aiming to provide a sort of smooth ride, relatively low volatility, albeit being invested in equities. And we favour companies with strong balance sheets and consistent dividend records. And we do also use the structural benefits of the investment trust, and I'll talk a bit about that using revenue reserves, gearing, and share issuance and buybacks to enhance returns. Next slide, please. So revenue reserves, the previous speakers talked about this, but as she said, investment trusts in the good years can save up to 15% of their dividends or revenues and put them into a revenue reserve. And this comes in very useful in periods such as in 2020, when FTSE 100 dividends went down by 36%, and yet because we had revenue reserves, we could continue to grow our dividend for our shareholders. It is a real advantage that investment trusts have. We also issue and buy back shares, and we've often been at a premium, and we've issued shares at a small premium, which keeps the stops the premium spiking upwards. At the same time, when we've been on a discount, we've bought back at a discount. Typically, we've issued at a 2 to 3% premium and bought back at a 2 to 3% discount. And then Emma also talked about gearing, and we took advantage of the period when interest rates were extremely low to lock in really cheap borrowings for our shareholders for the next 25 years. And so we've borrowed out to 2046 at 2.67% and out to 2049 at 2.94%, which are very low, very extremely low interest rates to be borrowing at for such a long period of time. So I'll explore some of these advantages in a bit more detail. Next slide. So this just makes the point about the share buyback and share issuance. So we've traded in a relatively narrow band. You can see this goes back to March 22, and we've been as high as a 2% premium to our net asset value and as low as a 3% discount, but no greater than that. Next slide. So I also talked about low cost borrowings, and the average interest rate that we pay on those two fixed rate notes, which I talked about a moment ago, is 2.84%. Well, that compares with base rates of 4.5%. We've got the Bank of England meeting on Thursday. I think they're going to increase, the consensus in the markets, they're going to decrease some interest rates from 4.5 to probably 4.25, possibility 4.0. There's certainly obviously better news on the inflation front, with the pound has strengthened a bit against the dollar recently. Also, the oil price has fallen a lot. So at the same time, wage growth is still an issue. And so I personally think the Bank of England will tread cautiously, but certainly the outlook, the view in the market is that there'll be further interest rate cuts this year. So despite that, the interest rate we're borrowing at 2.84% is still way below what base rates are at the moment. And also, if you look at what the government can now borrow at, which is around 4.8%, around 5% for 30 years, in fact, slightly more than that today. It's obviously shows you that it was a well-judged move to lock in borrowings when interest rates were ultra low. Next slide, please. So that's 58 years of dividend increase. That goes the whole way back to 1966. And there's obviously countries faced some quite difficult moments in those 66 years, but I think it's in 58 years, and I think it's just a mixture of having consistent companies in the portfolio and also using the revenue reserves during difficult times for dividends and saving a bit of the income in the good times dividends. That's really delivered that 58-year increase record of dividend increases. I mean, if you actually look at the portfolio and drill down as to where the income comes from, you can see it's a sort of not having all your eggs in one basket principle, in that it is a good spread of different industries. I mean, the biggest single sector for income is consumer staples. These are companies that make sort of basic everyday goods which people buy regardless, and the companies in this area tend to be very global that are held in the portfolio, so we're not kind of bound by the UK economy. And you contrast that with, say, consumer discretionary, which is the segment just above consumer staples. We only got about 4.4% from consumer discretionary. This is more cyclical areas such as retailers or travel and leisure, where demand swings in and out with the economic cycle. One area particularly heavy in is the financial sectors. Our second biggest sector is banks, and this is a change for me in that we've been had low exposure to banks from before the financial crisis for over 20 years, and about a year and a half ago we moved our weighting up in banks, and this is because a phenomenon called a structural hedge, which basically the balances that banks own, the UK banks in particular, which have been hedged at very low interest rates. So as these hedges come up, they're able to reset them at the much higher interest rates that are now prevailing. And this was some very good work done by our analyst on this, Janus Henderson, and convinced me to increase our weighting in banks, which was actually proved well timed, in particular buying into NatWest a year and a half ago. So banks is our second biggest sector. But if you actually group together banks with financial services and insurance, which are all kind of financial sectors, then you would come to some 36% of the portfolio. So, we think financial services and insurance and banks are something the UK does well, and there's some highly attractive companies in here, both offering very attractive dividend yields, like M&G or Legal & General in our view, or offering sort of differentiated growth like Beazley, a Lloyd's insurer where we've got a stake. So so we like the financial services sector. Next slide, please. This shows you the performance since I became fund manager in 1991, and we were well ahead of the all share index, which is our benchmark, the kind of main measure of the UK market over that 31-year, over that whole 33-year period. And we're also at the moment ahead of the index and also our competitors over 1, 3, 5, and 10 years. And our best performance tends to be in more difficult markets, historically at least, and with our conservative approach. Next slide, please. So to give a snapshot of the portfolio, we've got about 80 holdings. I mean, we're a large trust, so we do find, particularly with this getting exposure to the medium-sized companies, it helps to have around 80 holdings. We're predominantly in the FTSE 100, which is the largest UK stocks, 81% there, 10% in the rest of the UK market. We've got 9% in overseas listed. That was a lot higher. We were allowed to go to 20% overseas listed. It's come down a lot because we've seen a lot of value in the UK. And why is UK looking such good value? Well, I think over the years, UK insurance companies and pension funds have moved heavily into fixed interest. They see it as a way of reducing the risks, matching their assets with their liabilities. And to the extent they're in equities, they've gone very global, and the UK is a small part of the global market. The global market is now dominated by the American index, and the big American companies, like Microsoft on its own is worth more than the whole of FTSE 100. And this is where a lot of both institutions, also private wealth managers and private investors, have gone very global. And I think as a result, it's left the UK looking extremely good value. And UK companies are answering this in a way I'm going to show you, I think, in the next slide. Please move on to the next slide. Just before that, I'll just mention one thing about the UK stock market, and that is that it is actually very global. So it's not as if it's bound up in the UK economy. This is looking at Citi's portfolio. And if you drill down to the underlying revenues of the companies that we invest in, some 36%, 38% come from the UK, but the rest of the portfolio, 62%, is from overseas. And we have North America at 22%, and then you can see Europe 14%, Asia Pacific 15%, and emerging markets 11%. And the UK, I just talk briefly about the kind of prospects I see. I mean, the UK, the savings ratios is quite high at the moment. Interest rates are coming down, so the UK's got issue with growth for sure. But I think there is something in reserve there. I mean, the world is obviously waiting on what the president decides on tariffs, and I think only he knows what he's going to do next. But the tariffs could be quite damaging for the US economy in terms of both raising prices and also from a demand perspective. And it's hard to see kind of low priced manufacturing, like making trainers moving to America, or the Americans wanting it to move there. Europe, interesting news today with the German elections, but I think we're looking for a fiscal stimulus in Europe which could improve growth. Asia Pacific, dominated by China and Japan, and huge growth in China in recent years, but probably slowing down on some issues with debt there in China. And then emerging markets, where I feel there's a lot of potential as less developed countries become more affluent. And this is the big opportunity for our Western companies to sell into these countries. And today marked a trade deal with India as well for the UK. Next slide. So turning back to sort of what UK, so I mentioned previously that UK institutions have been selling UK equities and private investors have gone very global. So what have the UK companies done? Well, I've got two case studies from the portfolio, and basically they're buying back their shares in huge order. They're seeing huge value in their shares. And Shell is a good example. It's very comparable to Exxon and Chevron, the two US super major companies, and yet it's trading, depending which valuation measure you look at, a discount of probably around 40% or possibly more compared to those companies. So it is buying its shares back in huge order. For 3 years now, it's been buying for the quarterly share buyback. Annual basis, it's buying back just under 8% of its market cap, and at the same time, it's still yielding 4.5% dividend, and it's growing its dividend by 4.1% this year. So actually, given it's buying back so many shares, the cost of the dividend is actually declining for the company. So This is Citi's second biggest holding. It's 4.9% of our net asset value, or of the portfolio value. I mean, it's obviously an oil company, so it's going to be affected by what the oil price does, but it's got a very strong balance sheet, and it's the world leader in liquefied natural gas, which we think has a big role as a transition fuel as we move into a low carbon world. So it's it cut its dividend back in 2020, which I was very upset about at the time, but it has as you can see, recovered very strongly over since that period. Next slide. And my second example is actually a company called Imperial Brands, which is a tobacco company. And so this you'd be surprised to see how well this share has performed. But and it's got 5 main markets, of which UK is one. And of course, the UK has announced a smoking ban for people. People born from 2010 won't be allowed to buy cigarettes when they reach the age of 18. And yet, Imperial Brands' other main markets are US, Australia, and Spain. And yet, despite the smoking ban, and Germany's the other market, despite the smoking ban in the UK, these shares performed extremely well. And they basically were exceptionally cheap. A new management team came in and basically have kind of managed it much more for shareholder value. And they're buying back at the moment about 5.5% of the company in terms of market cap, in terms of share buybacks. It's got a 5.5% dividend yield. It's growing its dividend by 4.5%. It's our 7th largest holding. It's performing, extremely well. And at the current rate, the whole company would have been bought back, obviously in theory and not in practice, by the time the UK smoking ban really bites. So it shows that you can find value in the most surprising places. So next slide, please. So this is City London's top 10 holdings, and you can see a mixture of dividend yields. So you've got within the mix some quite 3 low yielders. Relics, which is a business information company, a very high quality company which I've held for many years, providing essential information to insurance companies, law firms, and also already using artificial intelligence in some of its operations, and really providing essential information analytics for companies, and very consistent compounder grower. And then BAE Systems, which is our big defense contractor. I mean, its biggest market's actually the US, but also obviously our main defense contractor in the UK, but a very big operation in Europe, and also huge growth opportunities in areas like Japan, and big operation in the Middle East, and also in Australia. So this company got very heavily sold the time when so-called ESG investing was the mania some 5 years ago, and we were able to build up our stake. And obviously with the Ukraine war 3 years ago, it sort of ended the post-Cold War peace dividend, and I think countries are recognizing the need to rearm, and BAE is providing essential service in that regard, and full of lots of good technology. And of course, AstraZeneca is the other low yielder, our leading pharmaceutical company. And then there are other companies, other stocks in the top 10. They're more for a mixture of yield and overall return, like BAT, British American Tobacco, and Imperial Brands. We've also got 3 banks now in the top 10. I mentioned that I turned a lot more positive on the sector, and we've had very good dividend growth as well as decent capital returns over the last 18 months from 3 banks, which are HSBC, NatWest, and Lloyds Bank, which are in our top 10. So the top 10 make up just under 38% of the portfolio. So it's a reasonable spread with lots of value elsewhere in the portfolio as well. So next slide. So to conclude, before I hand over to the next speaker, it's 58 years of annual dividend increase, which is the longest record of any investment trust. In fact, I know of no UK listed company that got a long record, or 1 or 2 in America with a longer record. But as I said, we've achieved that through having consistent companies that can regularly grow their dividends, but also in the bad years for dividends across the market, we've been able to use the investment trust structure and our revenue reserves in order to keep the dividend growth going. The ongoing charge, which includes the investment management fee and other expenses, is 0.37%, which is the lowest in our sector, which is the UK equity income sector, and in our view, very good value. In addition, we've achieved a long-term record of outperforming the FTSE All-Share Index, which is the kind of UK market as a whole, and we've achieved it through a conservative investment style. Thank you very much for listening.